Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. We begin with our top story. The S&P 500 posted its best day in more than a month as investors look through messy politics. Levitt of Invesco writing this: I don't believe that these markets will be trading based on Trump's or Harris's prospects, but rather on the direction of the economy and Fed action. I find the talk of the Trump trade versus the non-Trump trade to be much ado about nothing. Brian, good morning. That's music to the ears of a lot of people after politics has dominated the conversation in this country, in this market as well, for the last few weeks. What do you think is the number one issue right now?
I think it's the direction of the economy. And so you may remember I was here about a week ago and I said for the first time in a while I'm getting a little bit more defensive. Then you have a big rally in small caps and my thought is, oh, these folks are never going to have me back. But I still continue to believe that we want to be a little bit more defensive. It doesn't mean equities can't do well, but to what you were talking about earlier, it's the larger cap, it's the higher quality, it's because growth's slowing. Now, ultimately, I think the Federal Reserve pivots. So for the week after I was on the show, the focus was on the Fed cutting rates. Now the focus is back towards growth slowing. We'll get to the point where the focus is again on the Fed. We've priced in the couple of rate cuts now and things will broaden out. But in the near term, it's more of a defensive environment as the economy slows.
I've got a quote in front of me from Morgan Stanley, and I think it might resonate with you. It's from Lisa Shallett. She said, unlike cyclicals and unlike cycles, when Fed rate cuts precede recession and re-accelerating economic growth sustainably impacts the high beta small cap cohort, this time a Goldilocks soft landing is apt to reward large cap quality names that can deliver margin gains despite modest economic growth. Is that how you're thinking about things?
It is, although I wouldn't say that it doesn't involve the small caps. Because if you can get through this period with without a recession, I agree, then large caps should do well, the broad market should do well. But typically, if you look historically when the yield curve normalizes, the yield curve normalizing, you tend to see more participation from small and value. And investors have been wondering why this market's been so narrow. We've had 20 months of an inverted yield curve, maybe 21 months of an inverted yield curve now. So that's a challenge. This will change as we normalize the curve. But the problem in the short term is that we've priced in the rate cuts and the economy's slowing. You know, we've priced in a couple. So we'll need to see more carry through and more signs that this economy can be resilient before things start to broaden again.
I like that the market message and the political message is the same. It's the economy's stupid. And look at what's going on with respect to consumers and their happiness level. Are we getting a signal from the likes of UPS, from the likes of the airlines, from some of the commentary that we've heard early coming out in this earnings season that highlights just how quickly growth is slowing to you?
Yeah, I think so. And look, we have to remember that was the wish. You know, it was a year ago when things were robust and everybody was worried about inflation and we heard things like hyperinflation and stagflation and everyone was trying to be hyperbolic on these things. That was never going to be the case. The reality was the Fed was going to slow the economy, the fiscal stimulus was going to moderate, and consumers were going to start to slow down. Inflation was going to come back into the comfort zone. So that's where we are. So we can't wish for something and then when it happens, be disappointed that it's happening. And so, yeah, things are slowing in the U.S. The global economy slowing in the U.S. is a big part of that right now.
How do you assess whether this is just one data point on a different kind of trajectory downward that's perhaps a little more dramatic versus simply the Goldilocks softening that everybody was hoping for?
Well, if you look for the guideposts on a path to recession, you usually see cyclical excess. We don't have that. We do have the inverted yield curve. So far, we're 1 out of 2. You see signs that the economy's slowing. You look at survey data. It's not great, but it's not collapsing. And then the most important one is our credit spreads widening and our bankers tightening lending standards. Not really. So you would look at that and say the economy's in reasonably good shape. It doesn't suggest a recession, but the survey data suggests things are certainly slowing down.
If you don't think right now the Trump versus non-Trump trade is much ado about nothing, when does it becomes something to do about something?
I'm not sure it does. I know, my big North Star on that, I've been watching it the entire time from the day Trump was elected through the day Biden was elected, the market was up 70%. Since Biden's been elected, the market's up 70-something percent. So I'm not sure why people focus on this that much. And I'll give you an example. When it looked after the debate, post-debate, and Trump's numbers are going up, probability of winning, I'm getting these notes in my inbox that say, okay, here's the Trump trade. Crypto goes up. European defense companies go up. You want to be short Chinese equities. And I'm scratching my head saying, wasn't that the last 4 years? Right? That's exactly what happened over the last 4 years. The other thing is, if I were to have been here in November 2016 when Trump won, and I said, what would win, traditional energy or clean energy? Everyone would have said traditional energy, clean energy won by a lot. The exact opposite happened under Biden, where traditional energy won by a lot. And I have people saying to me, drill, baby, drill. If Trump wins, surely we're going to get back to drilling. We're drilling more barrels of oil right now than ever before in U.S. history. So I think people are looking at this wrong. I think people have their own perceptions, their own confirmation biases that they bring to it. But when you dig deeper, right, the Trump trade is energy and financials. Energy and financials did better under Biden than they did under Trump. So it just doesn't add up when you look deeper into it.
Let's park history and let's focus on one specific thing, policy and where we are right now. Mm-hmm. If you come in now and cut immigration and put up tariffs and put up walls around the United States of America, do you not see how that would be inflationary? If you extend the 2017 tax cuts, do you not see that that would be boosting the deficit at a time where actually there are things that people are nervous about, the prospect of inflation re-accelerating, the ability of the Treasury market to handle that additional supply?
Well, it may also be happening at the same time that the consumer's slowing a bit in here. So, you have counteracting forces against inflation, things like AI, things like older population. So I wouldn't necessarily say it's inflationary. To the market, what's going to matter most on all of these things is clarity. Give us some understanding of what this looks like, rather than when we did it in 2018, there was uncertainty. And so business investment dried up for a while with a lack of understanding of what it was going to look like. So long as there's clarity, the business environment will be able to handle it. Consumers will be able to handle it. And look, the reality is both sides seem to want to pursue somewhat of an American first agenda. So there's not a substantial amount of difference with regards to this America first approach.
All those conversations about politics you've been having on Wall Street, freezing cold water all over it. From Brian Levitt of Invesco. Brian, it's good to see you. Here's the latest. An unofficial AP tally has Harris surpassing the number of pledged delegates needed to secure the top of the ticket. President Joe Biden calling into campaign headquarters to offer his support in his first public comment since ending his campaign. Isaac Boltansky at BTIG says this: "We continue to believe it will be a close race, and we maintain our view that Trump is the slight favourite." Isaac joins us now for more. Isaac, let's start with the numbers. Follow the money. $81 million raised in 24 hours, more than $100 million donated to the campaign since Sunday, and yet your fundamental view hasn't changed. Isaac, why?
So look, the money that came in for the Harris campaign, I think, is a representation of the relief that's washed over the Democratic Party, given that Biden is stepping aside and they think that they have someone who can prosecute the case against Donald Trump in this election. But our view of this is that we still have probably 7 or 8 different narrative changes between now and November 5th. And when I peel back that onion and I look at the swing states that are going to define this, right, the ones that are going to actually decide this election, and you look at those 6 states, the issues that animate voters the most in those 6 states thus far have been immigration and inflation. And if that's still the case on November 5th, I think that Donald Trump is going to be the next president. The caveat here is no one knows what we're going to be talking about in 105 days. We've got to keep in mind, it was just 25 days ago or so when the debate happened and it reset the entire election. So we're going to have to deal with these narratives changing. And during that time of great uncertainty, I'm just going to keep going back to what animates the swing state voter.
when you look at the issues, this is why a recent poll showed that actually majority of Americans thought Trump's presidency was a success versus Biden's. If that's the case, then how does Harris differentiate herself from Joe Biden? He said there he wants to go on the campaign trail with her. Does she want him there?
Yeah, look, I think that in certain places, absolutely. I think that President Biden's going to spend a whole lot of time in Pennsylvania over the next few months. But I think that the Harris campaign, got to get used to saying that now, is going to enjoy some of those contrasts, Anne-Marie. Like, I really think, I don't think there's any example in modern political history of a vulnerability like age becoming weaponized this quickly with the switch in the top of the Democratic ticket. Age was their greatest weakness. It is now the cudgel that they're going to use to push back against Trump. So that's what you're going to hear a fair amount about. You're going to hear the fact that Trump is a convicted felon. The vice president is a former prosecutor. And of course, we're going to hear an enormous amount about reproductive rights, given that that's the one area that you've seen Democrats have success with animating voters in those swing states.
And she's been the face of that for this administration. But beyond reproductive rights, she was a prosecutor, but she was a vice president and a senator. But we haven't really understood what her core values are in a lot of policy issues. What differentiates herself?
Look, at the moment, the way that I'm thinking about this is I'm telling clients that there really isn't much daylight between Biden and Harris. I think that a Harris 1 administration would look a whole lot like Biden 1. There is good reason to believe that Harris is more progressive ideologically than Biden, but this has been a relatively progressive administration the past few years, so I don't see much of a shift there. Furthermore, we've got to keep in mind presidents are often limited by the other side of Pennsylvania Avenue, right? And we still firmly believe that the Senate is going to switch to Republican control. So what can be done there is limited. I do think that there are going to be subtle areas of difference in terms of trade policy and in terms of how they would push forward on the issue of fiscal policy and the expiring tax cuts. But it's all very subtle when you compare it to how Trump would do those things.
Isaac, markets would agree with you, and betting markets seem to suggest that generally people do believe that Trump still has the edge, although it has narrowed just slightly. I am wondering, though, about the bigger issue some people are saying, which is there is new energy in terms of bringing out voters, that potentially that could affect the down ballot races for congressional House and Senate seats. Do you buy that argument?
For the moment, yeah. I mean, look, the most surprising stat of many over the past few months has been the yawning enthusiasm gap when Biden was at the top of the ticket. 77% of Republicans were happy with their candidate. Only about a third of Democrats were happy with their candidate when Biden was at the top of the ticket. You're going to see that normalize, and you're going to see that gap close. And I think that will have an impact on the House races. And this is something that I think is important to hit. The House is going to be close no matter what. That is the reality from the gerrymandered system that we all live in. So the House is going to be plus 10 or 15 seats one way or the other. So it will be very, very close. And in that instance, I do believe that you're going to have an impact from this. And I think that it pushes back against the red wave narrative that we had all been seeing over the past few weeks. I think the House is going to be very, very close. My bet is the House goes whichever way the White House does, but it will be within a few seats.
Isaac, I want to speak to what you're telling your client base, specifically the client base in the investor community. When you put out the note over the weekend following this decision, there's a line that jumped off the page to all of us around this table. You said focus on electability and not policy. Just build on that a little bit more. What have you been telling clients about that?
Well, I think after the disastrous debate performance, I think everyone was trying to parse where the policy differences would be between Harris and Biden, right? And we were all going through her Senate record. We're going back to her actions as AG in California. And I just don't think that there's much value in that because they replaced the top of the ticket on the Democratic side, not because of policy, but because of age and cognitive capacity. Right. And I think that the similarity between Harris and Biden is a feature, not a bug. And so to me, it's just really a question of how she impacts this race rather than the policy substance. So is she able to change the dynamics in Georgia and get voter turnout within the black population, which is unclear that Biden was able to do in Georgia. It's unclear if that would have been there. How is she going to, in impact women and independent voters in some of those swing states in the Sun Belt. Those are the things that I think matter way more for markets and all of us trying to get our arms around this election than subtle differences between them, between Biden and Harris and their policy perspectives.
Isaac, with that being said, was J.D. Vance the right pick for Trump?
At the moment, it sure doesn't look like it was, right? I mean, I think that hindsight is something that really underscores the humility that all of us should have here. But at that moment, I think that Trump wanted to run up the score with his base, right? He wanted this to run up the score in Ohio and Pennsylvania and Michigan and Wisconsin with white, non-college educated voters. And I think that at that moment, he didn't worry too much about some of the other subsets. And J.D. Vance really does not help you with many other voter groups. And so at the moment, it sure doesn't look like the right one. But I think Anne-Marie really underscores the importance of who the vice president picks as her running mate. And I think that she is going to focus intently on someone that can help her in one of those swing states to broaden the base. That's why you're looking at Josh Shapiro, the governor of Pennsylvania, or even Andy Beshear.
Isaac, thank you, sir. Just wonderful over the last couple of days. Isaac Boltansky there of BTIG. With earnings season ramping up, Jill Carey Hall of Bank of America writing this: we still think pockets of small caps are poised for continued outperformance. Be selective near term. Focus on value stocks where we'd still stick with quality or profitable value. Jill joins us now for more. Jill, good morning. This is your turf. This is your world. So let's get straight into it. Small caps. When I buy the Russell, what am I buying and why should I be buying it at the moment?
Well, I think, we had gotten more cautious on the Russell 2000 as an index back in April when the inflation data had continued to come in stronger. And, really we highlighted there was two things that we need to see to get more bullish on the Russell as an index. And one is, more confidence that the Fed will be able to begin that cutting cycle, which now is what we've started to see and what was a big driver of the rally we've seen over the past week or two. I think the other is fundamentals and profitability. And that's where, the Russell does have a high proportion of unprofitable stocks. It saw a much bigger earnings recession than the S&P 500. And that's where I think investors are a little bit worried, because when you look at the beginning of the year, investors were expecting that by this earnings season, small cap profits would have come back, recovered, been better than large cap profits growth. And that's not what we've seen. We've seen a lot of hope held out for fourth quarter this year, a very strong recovery, but the first, second, and third quarters of this year, estimates have gotten revised down significantly. So I think that's what, we really need to see if we want to see if this rally is sustainable is, can we get good earnings data this earnings season, not only surprises to the upside, but guidance that supports that the fundamental backdrop is healthy for small.
So let's pick a sector, a dominant sector on the Russell, the financials. We can talk about the financials. The regionals have been a big part of the story now for the best part of 12 months. We've had a big rally there. Do you think there's reason to believe earnings will pick up and reaccelerate as we start to cut interest rates at the Federal Reserve, that things get better for that cohort of companies?
Right. Yeah, I mean, financials has definitely been a big leader of the rally recently. And certainly, if we see an outlook where we're looking for Fed cuts, where we're looking for soft landing, no significant deterioration in the economy, that should be supportive for financials. I think, when you look at factors like the regionals and credit conditions, that's still a risk that's out there. So, if we're in a backdrop where the Fed's cutting because economic conditions have deteriorated significantly, credit spreads are rising, that would be more negative versus a backdrop where the econ is still supportive. But certainly for financials, I think we've been due for a catch up, especially within small caps. Looking out, I think we still would be more cautious on some of the regionals, and it's an area where you want to be selective in relative to the large caps, which, large caps already got regulated. They saw their multiples contract for a number of years after the financial crisis. Regionals still could be subject to that. If we see greater focus on some of these regional banks that haven't had the regulation that the larger SIFIs have.
There's sort of a tortured relationship a lot of investors have with these names, just simply because they have gotten so beaten up that on a valuation perspective, they look great. And then you look under the hood and you start to see a lot of concerns. One of these numbers, I'm talking more generally, not just the financials. More generally, you put this out, that only 13% of second quarter reporters of small cap companies have beaten on earnings per share in sales. That compares to 51% of large caps. Can you give us a sense of why? Why smaller companies are struggling to really meet some of the expectations, even as large caps continue to outperform?
Yeah, I mean, it's been still pretty broad-based, where just that overall profits recovery has been much slower to come to fruition in small caps. And the earnings decline was pretty much across the board. And when you look at second quarter expectations, pretty much most sectors are expected to still see negative earnings growth this quarter. So, smaller companies have been more challenged. And when you look at the large caps, obviously a lot of the Magnificent Seven, some of the big tech stocks have been the drivers of earnings growth. We do expect that to slow and see a broadening out to the rest of the, other 493 of the S&P 500. So it's a similar story for small caps, but a lot of these smaller companies have still been challenged. You've had less profitable companies within the index. You've had sectors like healthcare where, that's been one of the sectors that saw the biggest decline and now is expected to see among the biggest recoveries. So I think when you're thinking about buying the fundamentals of these companies, that's why we've been, still more cautious on the overall index. But I think in pockets of small caps, there's still a lot of opportunity. And, as you pointed out, the valuation backdrop, the positioning backdrop is very supportive. Investors have been very underallocated to small caps. We've seen investors want to get more bullish on small caps. They've been such a laggard for such a long time. So I think the areas that are, perhaps less sensitive to refinancing risk, if there's still some uncertainty on the Fed, could be a good area. Areas that are sensitive to, still cheap but have positive estimate revisions if we're in a backdrop where that's still uncertain.
You went to the area that I wanted to go to. There's three pillars of economy, earnings, and politics. We're focusing on the first two. We've talked about earnings, but what is the read-through to the economy? This question of small caps ostensibly have more floating rate debt, are more sensitive to perhaps higher rates by the Federal Reserve. Is that a key reason why you're not seeing earnings increase at a faster pace akin to some of the larger companies that were able to lock in some of those funding costs that were really cheap earlier on?
Right. Yeah, I mean, small caps definitely have a lot more, as you pointed out, floating rate, short-term debt. Almost about half of their debt falls into that profile, whereas large caps, about 80% of their debt is that, long-term fixed rate debt. So, I think the fact that we've seen inflation start to come down and the Fed could be on track to begin cutting rates. Our expectation is in December of this year, but obviously the risks have been pulled forward that maybe a cut in September is possible. So, that eases some of the risk. The fact that we've seen credit spreads have been low. Some companies have been willing to refinance even though rates are high because, credit backdrop's been supportive. So, that's the risk, is if we see credit spreads, start to rise again, that could become a headwind to the profitability as well. So, I think this is a backdrop where you want to be selective within small caps and not just buy the Russell, which, we think further clarity on the profitability backdrop could help. But for now, our analysts at BofA cover about 1,000 small and mid-cap stocks. I think there's a lot of opportunities for alpha if you can focus on, like I said, the names that actually just have positive estimate revisions in a backdrop where revisions have still been coming down. Guidance has been weaker in small caps, some of the value stocks. But, we're watching what companies are saying this earnings season. If guidance can get a bit better, it's still been a bit weak, within small caps, then, companies beating and raising, I think, could be supportive of a broader, index rally and, similar to the risk rally we saw over the past week or two.
Jill, I have to ask about the third camp that Lisa alluded to, the politics. How much is small caps a bet on Trump-Vance?
Well, I think when you look at, the rally over the past week, really some of the initial drivers were more on positioning and, risk on. We saw financials as a big rally, deep value stocks. We saw stocks with high short interest rally as we saw some initial short covering. And when we've looked back, really, while certain political factors or political policies can certainly impact small caps when you're looking at tax rates or when you're looking at policies that could impact growth, overall, we found that profits tend to matter more than politics for small caps and for equities. So, I think what's going on with GDP and interest rates is going to be a bigger driver of the index than necessarily which political party's in office.
That's the piece of the story we're all waiting for. Jill, it's great to catch up. Jill Carey Hall there of Bank of America.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.